is Manishi Raychaudhuri, veteran investor. Manishi, um, how do you look at the market given the fact that we have geopolitical risk coming back, we have earnings now coming in, and they are decent by what we have seen so far?
Yeah. Thank you. Thank you, Sajid, for having me here. And a very good morning to you and your viewers. Now, in response to your question, how do I see the markets given all these headwinds that are approaching? A one word summary would be volatile in the near term. India was actually beginning to do quite well from June onwards as this massive AI anxiety set in. And consequently, the large North Asian markets turned wobbly. They still are. But I think, this recent resumption of the Middle Eastern hostilities has kind of put a spoke in that wheel. So while we had the rupee quite stabilizing quite nicely, we have had another spike in the US dollar and a consequent rupee depreciation over the last couple of weeks. Um, we are seeing some degree of earnings estimate upgrades, but they have also got a bit muted over the last couple of weeks. And on top of that, if we do have, the commodity prices spiking again, that would have an adverse impact on consumer discretionary, on industrials, and a whole host of other Indian sectors. So this is, basically two or three things need to be sorted out before we see a sustainable bounce back in bullishness. One, geopolitics, and consequently, the commodity prices, particularly energy, which would in turn stabilize the currency. Earnings recovery is important. Over the last 2 years, India has had a persistently declining earnings trajectory. Earnings estimates have always been whittled down. That needs to reverse. We're seeing nascent signs of that, but obviously, we need to see more of that.
Right. Manishi, hi, morning. I'm just wondering, what is it that you're making of IBM's commentary and, what does it tell you about investment here in India around IT services? Because they've clearly said that, the culprit is clients rotating CapEx into hardware now. It's about surveys, servers, storage, memory, ahead of price hikes or anything else.
Absolutely. And your question is actually visible on your screen. Just look at the IT service companies today. And I think this is going to remain a persistent concern. We still don't know what AI is capable of doing. And that landscape is actually changing every week, almost on a weekly basis or even at a higher frequency. We see new LLMs or the capability of the LLMs being enhanced. And therefore, what they're able to do today would be drastically different from what they're able to do tomorrow. And consequently, I think this concern that much of the work that's being done by the Indian IT services can potentially be replaced. This will remain an ongoing concern. I don't really see much of a way out for the Indian IT service companies, at least in the near term. In my model portfolio, I don't have any exposure to Indian IT, and I think I will remain that way for the foreseeable time horizon.
Okay. Manishi, also trying to get a sense, therefore, how do you position yourself within that IT basket? Do you position yourself among the large caps, the mid caps, ER&D, specialized services? How should one position themselves?
Well, as I said quite clearly, I have zero position in Indian IT right now. I don't have the large caps. I don't even have the smaller mid caps. But going by the recent earnings reports and possibly in the commentary in the previous quarter also, I think that small and mid cap space, particularly the mid cap space, is possibly better positioned. But what all Indian IT companies would need to do is to rediscover themselves. I mean, they will obviously be working for the AI LLMs, and they will have a role in this entire AI deployment story. But what that role is going to be and what it would mean for the revenues and earnings of these companies, that is not clear at all. And meanwhile, you have far better opportunities in other sectors in India. So, for an investor like me or for most foreign investors, there's no point, arguing about that particular sector endlessly.
So, Manishi, what is it that you're liking right now? And more importantly, where is it that you can cut your losses? And, what sectors provide safety in this very volatile world environment?
Absolutely. Great. So I will name 3 or 4 sectors. Number one, industrials. And that's a broad definition that would include capital goods, that would include defense companies, that would include much of the industrial infrastructure, providers and the construction companies. But remember that these industrial companies, they're also kind of participants in this AI deployment, scenario that we're seeing. Massive data centers will have to be put up in India, and we have already seen the orders coming in. Many of the industrial companies are participants in various segments of that deployment. Number two, I'm also positive on the base metals, particularly steel. If one does a simple exercise of looking at where the earnings estimates are going up, and within that, which companies are looking reasonably valued relative to their forward earnings growth, these base metal companies, particularly the large steel companies, would figure prominently. Number three, consumer discretionaries, and that's also a broad definition that includes automobiles, that includes several others, including the e-commerce companies. And this is another area where we are seeing earnings upgrades gradually coming in, maybe over the last 2 months. The only risk to the sector is a spike in commodity prices, which could derail that earnings upgrade story prematurely. Finally, private sector banks. This sector has derated and it has underperformed for more than 2 years. But over the longer term, private sector banks are the ones which would gain market share. Look at the loan growth. It is the bank loan growth, the non-food credit growth is back to 17 to 18%. It has recovered quite sharply. So I think those are the 4 sectors that we are focusing in for the time being.
Okay, Manishi, talking a little bit more about industrials, some of these names, and of course we can go into subsegments, but some of these names have run up and run up very sharply. They're pricing in multi-year earnings growth and very strong earnings growth. And we've seen that sometimes some of these stories can fall flat. I mean, we've seen it in retail to a large extent. We've seen it sometimes in FMCG as well over the last few years. Do you believe that's a risk we run?
No, you're absolutely right in pointing out that many of the stocks have run up very sharply. And therefore, I think one has to be selective in this sector, particularly about valuations in relation to forward earnings growth. So there are 2 or 3 parameters that we look at. Number one, how are the price earnings or price to book multiples appearing not just on a standalone basis, but relative to what the consensus earnings growth or return on equity estimates are going forward. Second, the kind of order backlogs that many of these companies have. And in this respect, actually, an example, not from India, but from Korea comes to my mind. If you look at the Korean defense companies like Hanwha Aerospace or Hyundai Rotem, their order backlogs are about 5 to 7 years of their annual revenue. So that gives a degree of visibility to the investors who are going to invest there. And of course, the Korean companies are still a lot cheaper, despite the market having run up so sharply. So I think those are some of the parameters that investors need to look at.
Interesting. And Manishi, what is the view on global investing in light of China's GDP, which has come starkly lower this time around? And then, of course, the entire AI rally, which, of course, does have certain speed bumps every now and then in the US.
Now, of late, if you look at last 1 month or so, I mean, the biggest concern, facing emerging markets or global markets in general are possibly two or three. Number one, there's an inflation concern, particularly in the United States, although that has been assuaged a little with the most recent data point, the CPI, which came in at below 4%. And as a consequence, there's a lingering concern that at some stage the Fed would raise rates. And I think that's now percolating down to Asia also. We have seen a few Asian central banks already do that. We've seen Indonesia do that. We've seen the Philippines do that. Even Australia and New Zealand in that region. The central banks have actually turned around to the other side. So that is one big concern, which has led to the spike in the yields. I mean, the 10-year yield in the US is about 4.5 to 4.6% now. Second, this whole AI anxiety, because investors are so, worried about where the monetization would come in, that their actions in the North Asian markets have led to immense volatility. And in those markets, particularly in Korea, there was a huge degree of leverage built up. I mean, if you look at retail margin loans, that has reached an all-time peak in Korea. So all these things put together have, led to this volatility that we're seeing. What you referred to in China is a very disappointing domestic retail sales scenario that actually turned negative, and it's been declining over the last 6 to 7 months, which means that the companies operating in China, the consumer discretionary and other companies, they're not generating any margins whatsoever in the domestic market. And all their margins are coming in from export activity, particularly to Europe. But we have to contend with geopolitics. We don't know how long those margins supporting export activity can continue. And I think this is what, investors are grappling with right now.
How do you look at some of the other asset classes, Manishi? The 10-year US yield is currently tracking around 4.6%. You've got gold and silver, which have fallen quite sharply and precipitously from their highs. Any of those looking like interesting places to park money, at least tactically?
Yeah. In fact, what you pointed out about gold, Hirsch, that's a direct consequence of what we have seen in the US bond market. And it is because the yields spiked so sharply that the bullion or the precious metals market fell precipitously, because after all, things like gold, silver has some degree of industrial usage, gold has none. And there's no cash that comes, there's no dividend to be, that comes to the investor from those investments. So it's basically some degree of future value which is discounted to the present value for all these precious metal companies. And so that's why when yield spikes, the perceived present value falls sharply. And that's exactly what we're seeing. So until and unless we see a degree of stabilization in the yield expectations or, expectations about what the Fed is going to do going forward, I don't think the volatility in the precious metal market would be eased. Now, having said that, I think bullion is an essential part of the the multi-asset holdings that an investor should have. Whether it should be 5% or whether it should be more than that is a different question. But it's something essential, in the world of uneven geopolitics that we're seeing today.
Absolutely. Manishi, so good chatting with you today. Thank you so much for all your insights.
Thank you very much.